Welcome all, and thanks for listening in to this quick fire Q&A session today. We're pleased to have with us John Andrews, who is a partner within the corporate and commercial team at JMW Law, in addition to having David Roberts with us, who heads up the freight and logistics transactions team at Connect Corporate Finance. Both are joining me today to give some insights into the challenges business owners may face during the exit process. We're going to kick things off with a quick introduction of ourselves. For myself, so I head up the deal origination team here at Connect Corporate Finance. And to give you some insight into Connect, we focus our time on mergers and acquisitions across two sectors, one of which is the freight and logistics space, and the other is recruitment and staffing. And we're either working with larger, more aggressive growth companies and assisting them with deal flow during the acquisition process, or the other side to the coin is when we're working with SME business owners and helping them during their exit strategy throughout the sale process. Myself, in my role as head of deal originations, I speak with business owners across both sectors, managing their relationships and understanding where they are in their strategy, whether they're looking to grow via acquisition or they're looking to explore the sale. And we're eager to listen to business owners on a daily basis to hear what they want to do. I'm going to pass you on to David Roberts to give you insight into his role at Connect.
Thanks, Luke, and appreciate the time to speak with you guys today and bring this to our network online. So I head up the freight transactions at Connect Corporate Finance, and I work with management teams and business owners and shareholders to offer services either on the buy side or the sell side M&A process. We're sector focused here at Connect, and ultimately we have a network across the globe within all modes of transportation. So what we're essentially able to do and are doing on a daily and weekly basis is introduce either our sell side clients to the strongest acquisitive buyers in the market, or find our buy side clients off market opportunities that they can potentially bring into their organization and acquire them. I head that up.
Thanks for that, Dave. And John, do you want to just give us a quick intro to yourself and your role at JMW?
Yeah, thanks very much, Luke. Well, morning, everybody. Thanks for joining us. I'm John Andrews. I'm a partner in JMW Solicitors at their London City office. We're a top 100 firm. Personally, I deal with mergers and acquisitions work, primarily for SMEs, and with a particular focus in the logistics and healthcare sectors.
Thanks for that, John. And guys, today we're going to run through some quick fire questions that we certainly get asked on a weekly basis from business owners that are looking to explore that sale process, and hopefully you'll be able to give insight into what you've done throughout your careers. So to start things off, guys, it'd be great to get both of your opinion on when is the right time to engage with an advisor.
Yeah, do you want me to deal with that one first, David?
Yeah, by all means.
Okay, so to some degree, it very much depends upon how experienced you are in doing deals. Some people want their hands held from a very early stage, which we're happy to do. Others are more experienced and agree their heads of terms, come to their lawyer and say, that's a deal, put it into a formal contract. Generally speaking, I think the best time to approach us is when you've finalised the commercial terms, when you may have a first draft of the heads, in my view, and then before they are finalised, maybe get us to have a look over those, make sure there's nothing fundamental that you've missed out, make sure there are no issues that we think you should perhaps include in those heads. But generally speaking, I think when you've got the deal agreed in principle and you're looking to tie those down into formal heads is probably the best time to approach us.
Yeah, for sure. Yeah. I think from a sales perspective as well, Dave, would you like to give your insight into that?
Yeah, I think John's exactly right there. I think the message from us as advisors is ultimately just to plan ahead and know what is necessary ahead of needing to do it. So consulting your accountants, your legal advisors, and indeed your corporate finance advisors as well, because they will have been through that particular process many more times than you have. So there may be certain things within the business well ahead of actually pressing the button on a sale or a purchase that you need to do in order to be best prepared to get a successful outcome. So I think, just consulting people early on is always what we would advise.
Yeah, for sure. And especially in my role, speaking with business owners that may not even be ready to explore the sale process and push the button on that, we certainly welcome those conversations, and we're here to sort of educate them on that process. But John, the next question following that one is when and what should a vendor be conscious of and look for in a prospective lawyer? Why should they potentially come to JMW?
Well, I think the key to it is this, and whether it's JMW, myself, or any acquisitions lawyer, the key to it is that doing M&A work is specialised work. So you want a lawyer who knows what they're doing in this sector. That they need to know the process, most importantly. And in knowing the process, it also means that they have a really good general overall knowledge of what the market norms are. So when you are negotiating a deal, when you're negotiating a contract, what you want to know is that your lawyer has a good understanding of the process, and also knows what points to take and to argue strongly, what points he can give away, and what overall is a fair form of contract. Because at the end of the day, if you're a seller, you sell your business once. You're exposing yourself to potential liabilities, and you want to know what the acceptable risks of selling your business are. On the other side, if you're acting for the buyer, you need to know where the potential pitfalls are in doing a share purchase or an asset purchase. And again, having experience of dealing with transactions gives you a broad knowledge of a number of sectors and what you can and can't give away in the contract itself. At the end of the day, also using an M&A expert means the process should go along quicker, and it should be smoother, because you don't get silly points being taken in the negotiation process.
Yeah, for sure. And I would also vouch for that in terms of getting a lawyer who knows the space of which the business owner operates in as well. That makes a difference in terms of them seeing a lot of transactions. They know what to look out for, etc. But John, it'd be also good to elaborate on that point in terms of the legal steps that are actually involved in the sale process. Could you delve into the heads of terms, SPA?
Yeah, absolutely. So generally speaking, the process, whether it's a share purchase or an asset purchase, and we'll discuss later the difference between the two, is more or less the same. So the clients will start their negotiations. The first thing generally they'll have drawn up is the heads of terms, which set out the broad parameters of the deal, so how much is being paid, how it's being paid, and any particular issues that need to be incorporated into the contract. Now, the important point to emphasise is, generally speaking, heads of terms aren't binding. There are a couple of exceptions to that. Sometimes a buyer will want to know that they've got exclusivity for a period of time, and they will want to know that they're not going to incur costs in carrying out due diligence and investigating the business without having that period of exclusivity. So it's common for heads of terms to say, if you breach exclusivity, then you have to pay the purchaser's costs. But that will be the only binding element of the hedge, generally speaking. Next stage will be to proceed to set up a data room and serve what's known as an information request. And this is where the buyer asks questions about the business. The seller has to answer those questions and upload supporting documentation into a data room. The buyer then conducts a due diligence process, looks into the business, and will instruct his lawyer then to draft a share purchase agreement or an asset purchase agreement. That gets negotiated between the parties. There are then a number of ancillary documents that need to be drafted. So if it's a share sale, there'll be board minutes, resignations, appointments of new directors. Don't usually have that with asset purchase, so it cuts out a little bit of the work. And then after you've done all the ancillaries, you'll proceed to a completion where the monies are paid over, the documents are signed and exchanged. Usually exchange and completion takes place on the same day nowadays. And then post-completion, you have all of the filings that need to be done at Companies House if it's a share purchase. So in a nutshell, that's a whistle-stop tour of a sale and purchase.
No, I appreciate that, John. And David, maybe to delve into what John alluded to there in terms of the data room and the due diligence process and sort of the granular detail that buyers do go into, what sort of advice would you have to potential sellers that are thinking about their exit and getting their business ready for a sale?
I think with any buyer, understandably, what they're trying to do is mitigate the perceived risk in an acquisition, and ultimately the due diligence phase will be an opportunity for them to look through everything in great detail, and they will work very closely with the vendors to ask operational, financial, and legal questions on the business and its history, and they will form, or that will help them form an understanding of that business and be comfortable that the deal in question is the right one for everyone concerned. So I guess it's to it's a phase, and what we explain to our clients is that it is quite an arduous task. It's absolutely required for both teams, and it can be a good exercise for the vendor and their kind of close allies within the business to get things in order and gain a firmer understanding of their own business. But I think once the buyer is comfortable with everything that has been put in the data room and been sent across, once you get past that due diligence phase, you really are taking a step, much closer to the deal finalizing, and it's an absolute paramount activity in any deal. The due diligence phase is required.
I think that's a really good point, Dave. And another thing I'd emphasise is, and this is part and parcel of the sale process. It's really important, whether it's with you guys or with the lawyers, if somebody's thinking about selling their business, to get their business looked at before they start that process. So, are there employment contracts in place? Are there contracts with key clients and key suppliers? Because in the due diligence, if I'm acting for a buyer, these are the things that I want to know. And if they're not there, they're either going to kill the deal, or what they're going to do is that they're going to open up an opportunity for the buyer to start negotiating and chipping on the price. So that's why getting your business prepared for sale is just as important as the actual process itself, I think.
Yeah, I couldn't agree more with that, John. And that's why we like to speak with business owners as early as possible, just to educate them on that. And moving on to my next point, John, you mentioned it when we talked about the legal steps involved, but do you want to delve into the sort of differences and why a buyer may look at an asset versus a share purchase, and what should the vendor think about when they're assessing their options?
Yeah, absolutely. I mean, and this is a fundamental decision to take. Now, if you are a sole trader or a partnership or an unincorporated business of any type, you only have one option. You have to sell the assets of your business. If you're a limited company or you're trading as a limited company, you have the option to do a share sale or an asset sale. So if you do a share sale, what you are essentially doing is selling the shares in your company. So there is no change in the trading entity before or after the sale. It's just simply that the person or people that own the business, i.e. the shareholders, change. Now, what that means is that the buyer is taking over an existing trading company. The advantages of that are there's no need to notify clients or customers usually that there's been a change of ownership, and there's no change in the contractual relationships between suppliers, customers and employees. So for example, the transfer of undertaking regulations, which apply to asset sales, I'll explain what that is in a minute, don't apply to share transfers, and TUPE, as it's known, is quite an arduous process. So generally speaking, from a seller's point of view, a share sale will be preferable for a number of reasons. First of all, it gets them away from the company and the business entirely. It's also more tax efficient because subject to certain qualifying criteria, the tax they will pay generally on those sale proceeds will be 10%. They'll get entrepreneurs relief. From a buyer's point of view, a share purchase is more risky because you're taking on an existing company with any skeletons in the cupboard that you may have. But administratively, it's easier because there is no change in the trading entity. With an asset purchase, and this is where you are a sole trader, a partnership, or you own a limited company, but the buyer only wants to buy the assets of that business, not the company itself. The advantages of that for a buyer are that process is less risky because you're not taking on an existing trading entity. You leave behind generally the history and the liabilities associated with that business. And the due diligence process, therefore, can be less arduous. The biggest risk in buying a business, generally speaking, is going to be liability claims from clients or customers and historical tax issues. With an asset purchase, you don't have those issues. The downside of an asset sale will be, first of all, transfer of undertaking regulations apply. So you have to notify the staff this sale is going to take place, and it's more difficult to change their terms and conditions of employment if you're the buyer post acquisition. Secondly, as a buyer, if it's an asset purchase, you will have to notify clients and suppliers that you've bought the business, and sometimes you require their consent to transfer the old contracts across to your new company. And from a seller's point of view, an asset purchase, if you are a trading as a limited company, is far more tax onerous. There's a double tax charge because if you sell the asset, it's the company that sells the assets, not you personally. So the proceeds of sale go into the limited company. So there's corporation tax to pay on those receipts. And then as the owner of the business, you have to get those receipts out of the business. So they can only come out by way of dividend or salary. So you pay tax again. So far less tax efficient if you're a seller.
Sure. And thanks a lot for that insight, John, and hopefully that certainly has educated the listeners today. Dave, moving on to sort of the next question in terms of the deal structures that we see within the industries that we focus on. Could you give some insight to what you're seeing in the market at the moment?
Well, I think the market has certainly changed over the last kind of 6 to 12 months, where we look back maybe a little bit longer when COVID first came about. Within the M&A space, ultimately transactions were just completely sidelined, terminated in a lot of cases, and it was a really difficult period in time for intermediaries like ourselves, but also buyers and sellers that would have worked extensively at trying to get deals done, but were unlucky, just with the wrong time, with a global pandemic that hit. That no one could plan for. Ultimately, a lot of those deals just simply, did not transact. But I think undoubtedly since Q4 of last year, deal volumes have come back with vengeance and continue at pace. And what we're seeing is, there's certainly not a drop in appetite from our perspective, within the freight and logistics industry. I would also extend that to our secondary market of recruitment and staffing. I think, businesses have been able to ride the COVID wave and have, consolidated their own individual businesses for a period of time. But many of our clients have actually done, tremendously well during that period. And there's multiple factors, certainly within the freight industry, that have meant that, businesses right now are actually in a period of absolute growth, and top line revenue is larger than it's ever been for various reasons. But what that has meant is ultimately that appetite is sky high right now for good quality assets across the globe. And I think, there's a lot of people that certainly on the sell side who are potentially coming towards the end of their business life cycle are now at a period of time where their decision may well have been expedited, and they've seen this pandemic as an opportunity to look at what might be important to them, and possibly now sped up their decision to sell the business. So there's lots of different things, but certainly the pandemic has not stopped people wanting to do deals if they strategically make sense, and there are structures that we are seeing that enable both buyer and seller to mitigate some of that risk element. And during a process, when we speak with our clients, it's all about the risk associated in the transaction, both from a buy side and a sell side. So I think undoubtedly the earn-out type model is one that is used most frequently. Certainly in the freight and logistics world, it is largely a non-contractual space. So the customer relationships are often, on a goodwill basis. You've built that up over X amount of years, and the relationship is non-contractual. So that does bring a level of risk to a buyer. And what a buyer is looking to do is often pay a proportion of that enterprise value on completion, but then certainly look at having a period in time in which the business and its customers and staff are handed over, hopefully successfully, to that buyer, and enabling the owner to be paid out when performance related targets are met. And often it's just to maintain the level of performance that it is shown perhaps for the last 12, maybe 24 months, but often the last 12 months is what that target will be based on. And ultimately that buyer is looking to inherit the business that they thought they would at the point of completion. So it's about just safeguarding their investment and working with the vendor to ensure that the business and its customers are passed over in a seamless manner.
Yeah, I think that's a really good way of summarising the market at the moment. And what I've seen in the deals that I'm doing at the moment, David, is that there's far more willingness between buyers and sellers to be creative about the way in which the consideration is paid. And it's striking a balance between the seller getting enough up front, I think, to be comfortable with what he's receiving on day one, and the buyer's willingness to put that sum up front, but then spread the risk and share the risk with the seller as the balance.
Absolutely, and I think within a largely a non-contractual industry, I think vendors and owners are fully aware and appreciative that 100% of that purchase value paid out on day one is very, very, very unlikely, and often nowadays, especially on the back end of the pandemic, a deferred type deal structure is also not all that common whatsoever. So, I think undoubtedly earn-out structures are what we are seeing on a daily and weekly basis. And quite right, John, I think ultimately, if you can find a mutual position where both parties understand the risks involved and are happy with the element that they're having to pay out or receiving on day one, then those are the types of deals that more often than not are happening in our space, for sure.
Yeah, so it's very much a balancing act to ensure that both sides are sort of happy with that risk, and the buyer's obviously going to look to mitigate that risk. But yeah, the market is certainly buoyant at the moment. It feels like we're looking at another transaction every day across both the sectors that we focus on. It's certainly an exciting time for sure. But guys, that does wrap up the quick fire Q&A session today. So I'd just like to round things off by giving a big thanks to John for joining us, and also Dave for taking the time. And hopefully you listeners have found this informative and learned a bit more about the sale process. If there's any more questions that you'd like us to answer, please just drop me a message on my LinkedIn or email at luke@connectcf.com. I'll certainly look to come back to you on that. But no, a big thank you from me, guys. Thanks for joining.
Yeah, thanks, guys. Cheers.
Yeah, thanks, guys.